Hello, everyone. Good morning, good afternoon, good evening. This is Hoda Mehr, founder and CEO of Stock Card. And today we've got a quick show I'm going to do in the next 15 minutes. Go through Shopify. And the reason Shopify is on my radar today is because of its latest earnings report. The company has released its earnings report in this week, and the stock is already up double digits from where it was before the earnings release. So it's very interesting what's happening with Shopify. It went IPO in 2015 or so, around $2-3, and then it went high up to around, if I'm not mistaken, $188 or 180 something dollars in the middle of last year. And that is almost a 69-70x return from the IPO. And then what happens is that the stock price has drastically fallen down to around, right now is about $33. So that is very interesting. This company was on the track to get to that 100x or 100 bagger status that we've been talking about since its IPO to the middle of last year. And then it has drastically fallen down from its all-time high or 52-week high down to $33 or so in per price. So today it's going to be all about digging into the company's information and the latest earnings release and figure out whether Shopify can be the next 100 bagger stock. So without further ado, let's jump in. If you're watching live, feel free to put some comments if you put your comments or put your questions or your ideas in the comments section, and we're gonna get started right now. So this is the context, as I was just telling you. We're looking for whether the Shopify stock can be the next 100 bagger or not. And let me bring the Shopify's stock card right over up for you guys, so to take a look at the company's status and what I was just telling you. Stockcard.io/Shopify. If you haven't used the stock card this way before, if you put the stockcard.io /any ticker, you're going to get that company's stock card right up for you. So while this is loading, what we're going to go through today, as I said in a second ago, is to figure out whether Shopify is the next 100 bagger stock or not. And this is what's happening. This is what's very interesting about Shopify's stock card or information. The company was, if you look at its all-time return, it went IPO'd at around 2.7. This is a split suggested $2.7, and it went up all the way to something around 180 or something. So that's a 69x return in a matter of that IPO time frame. And then it's been falling down from that all-time high to what it is, $33 per share right now. So if you look at its opportunity from its all-time high, you see there's a 80% opportunity if it can go up to where it was at its all-time Hora's 52-week high. So obviously that's a good return, 80% return, but we're actually looking at Shopify to figure out whether this company can be the next 100 bagger. So as usual, as you know, I have this framework that I use for figuring out whether a company can be the next 100 bagger or not. And these are the few criteria that we're going to go through together today to figure out Shopify's opportunity. The first characteristics of a possible 100 bagger stock is whether the company is small enough in the market cap to be able to qualify as that next 100 bagger. So that's right off the bat. It's one of the problems that I see with Shopify is that it's already a $40 billion company. It's already a $40 billion company. If you compare that to something like Amazon, a lot of people tend to compare Shopify with Amazon, although these have two very different businesses, but they're sort of betting on the future of commerce, or e-commerce, or retail, if you wish. And that, even if Shopify can get as big as Amazon in market cap, and Amazon's market cap right now is something around $1.1 trillion. So $1.1 trillion over $40 billion market cap for Shopify. That's not quite the 100x return opportunity that we've been talking about. So yes, Shopify can be significantly bigger, but it's already have a big market cap, so that would make it a little bit that would make it a little bit difficult. I'm gonna summarize what we just talked about around the market cap. So it's not small enough to qualify as the next 100 bagger, but it doesn't mean it cannot get there. Like a few years ago, nobody was thinking that nobody was thinking that we were going to have $1 trillion companies like what we have right now with Amazon or what we have with Apple. So it is not out of realm of possibilities, but it's just a lot more difficult to get a company from a $40 billion to become, if it was a $4 billion company, that would be a slam dunk, right? It's just the sheer size. Okay, but moving on from size, does it have consistent revenue growth? We've talked about this in previous live streams. If you want to look at one criteria to evaluate a company, is its revenue growth, it's its sales revenue growth. If a company doesn't have anything figured out, but have found a way to consistently grow its revenue, you basically have that unique opportunity. To invest in something that have found a way to convince other people to pay for it, right? So the company's revenue growth, as you see, I clicked on the financial strength section of company's stock card, and then it looks like it's in revenue. It's one of the metrics that we obviously use based on 6 different analysis. The company has a solid and strong growing revenue. So let's go and look at it. From a quarter over quarter point of view. This is last quarter, so not the latest quarterly earnings, but the last quarter. The company was growing at 7.6%. On an annual basis, company has been growing by 123%. On a 3-year compounded annual revenue growth, the company has been growing by 70% per year and beating its peers all the way along the way. Actually, this one is the 1 year is 57%, so not beating its peers, but it's still a significant growth rate. And so from a revenue growth point of view, Shopify have already been able to achieve that unique criteria you would need in order to evaluate a company to be the next 100 bagger. So let's summarize that. Yes, solid revenue growth potential for the company. Am I typing? Yes, yeah. Yes, solid revenue growth, not potential, track record, right? Revenue growth track record. Although it has a slowdown, quarterly, right? On a quarterly basis. Latest quarter. But I'm not worried about that as long-term investor. And even if you want to invest in the next 100 bagger, we know there will be blips. There will be quarterly blips in the company's performance. So that is not something that we want to be worried about just yet. It is still a company that is rapidly growing, regardless of those small blips in quarterly earnings report. I did bring the company's analyst section and the latest quarterly earnings report. I do want to show you how the company has performed in its latest quarterly earnings. Typically, it takes a few days for the quarterly earnings that is submitted to the SEC to appear in financial data systems and appear on a stock card. But we can always have access to the company's quarterly earnings report in order to on their own websites in order to be able to evaluate what's happened in that quarter if you need the data immediately. So the September 30th quarter, the quarter that ended in September 30th, sort of confirmed that the score we just gave the company, which has a consistent sales growth, and we see that the revenue was almost 4 versus revenue of 1.1, and that is obviously significantly higher, meaning that the company has been able to generate growth. So definitely the score we gave him from a consistent revenue growth point of view, it's possible, it's valid. The next criteria we use is that does the company have a history of expanding its earning power? And this is a very difficult question to answer for a company like Shopify. That's because Shopify hasn't been consistently profitable. So if this was a company that was profitable, in order to evaluate its earning power on a consistently basis, in order to evaluate its earning power, we would have looked at something like ROE, return on equity, which is part of a company's financial strength. And we would have gone to this management effectiveness and looked at its return on equity, which basically tells you how much money the company generates per $1 of equity that investors have put into that company. And Shopify is because it's in that early stage of its growth, it still is not profitable. So when we talk about something on like return on equity, we obviously get to negative numbers. So with this criteria, we can really figure out whether the company has that earning power. But what is interesting about its return on equity is that at least if you think about it on comparison with its peers, it's in a better position. And if you compare the ROE growth rate, you see that in a 3-year, on year-over-year, and even on a quarter-over-quarter, even though it's negative in some quarters, the negative amount is basically coming down. It's shrinking. So it does have those solid first steps in order to become considered as high earning power, but we're still not there yet. So we're not going to dig further deep in it, but this is one area of concern that I have about Shopify is that has it found its ability to generate sustainable return for its investor over the course of years, so that and the reason this is super important is that if you found this sustainable source of earnings for your company, it means that you don't need to go and keep raising capital from external sources in order to be able to fund your company's future. You can basically use your own earnings. So the concern is, has it found a sustainable way? I'm going to write it here down, sustainable way to fund its future, right? We don't know that yet. Although for a company like Shopify, we can look at its balance sheet, and there are really, really good signs that it has really solid balance sheet. And I'm going to go to its financial resilience ratio. We see based on 28 analysis, it's solid good. So from a balance sheet point of view, amount of cash available to this company, cash versus debt, this company is in really good shape. It has been able to, in a few quarters, it's been able to reduce, in few annual reports, it's been able to consistently generate free cash flow, although in the recent quarter it's not as good in this year. So that's why it's not a red cross out, but it's questionable whether it has found that sustainable way to fund it. So something that we're going to watch for in the next few quarters is that watch for the company's ability to fund its future growth through its free cash flow and earnings, right? Those are the few things we wanna watch for. All right, so we're already 15 minutes in, and my goal was to go through this as fast as possible. But if you're around, if you want to stay around more than 15 minutes and go through the rest of it, I think it's going to be quite interesting. We're looking at Shopify's possibility to be the next 100 bagger by looking at this latest earnings report. I mean, its annual report. And the next thing we're going to look at is that does it generate free cash flow? We actually just looked at it together. We went to the free cash flow section of the company's stock card, and we just had a conversation that on a quarterly basis, in the recent quarters, it has been a negative free cash flow generator. But if you look at it in the last fiscal year, 2 fiscal year, 3 fiscal year, it has been able to generate free cash flow and increase that free cash flow on a sustainable way. So from 8 million 3 years ago to almost 400 million 2 fiscal years ago, and almost 450 million in free cash flow in the last fiscal year. 2022 is probably not going to be as solid, but we know that's like an externally driven problem that's happening in the economy. So when it goes to the criteria of does it generate consistent cash flow, I would give it a yes here. Yes, seems to be able to fund its growth through its free cash flow, which is a very, very good sign, right? For a company, for a 100 bagger, one thing that is quite important from what I've studied is that you definitely need the company to have found that growth engine to be able to use its own funding, its own revenue, its own earnings to be able to fund its future growth. So it's definitely a good yes. We have 3 more criteria to review based on the company's current performance and the company's latest quarterly earning to figure out whether Shopify is the next 100 bagger or not. So the next one is that do you have a chance to buy it at low multiple? And this is very interesting. Typically, when you're thinking about a long-term investor, like I'm a long-term investor and you guys are also long-term investors, a lot of you in the stock card community, we rarely talk about multiples and we rarely talk about the valuation. But, all else equal, if everything else is equal out there, if you have a chance to buy a company at a lower valuation, why not, right? If you're investing in a next 100 bagger and there's a possibility to buy that company at a lower valuation, why not? What it looks like Shopify, obviously, we just looked at it at the beginning, is that significantly lower than its sort of 52-week high of 176. So that's like a significant difference, almost 80% difference. But if you look at its valuation metrics, which is things like price to equity, price to sales ratio, it doesn't mean that the company is undervalued, even after 80% drop from its high valuation. So let's look at some of those things. PE ratio, it doesn't have any E, so there's no PE ratio. So we can't really use its PE ratio. And analysts are expecting small amount of earnings in the future. That's why you see this crazy price to earnings ratio. But that's really, honestly, it's not useful for this analysis. Maybe something that is a little bit more informative when it comes to a company like Shopify is price to sales ratio. And price to sales ratio is basically our expectation in terms of how much more the company has to grow its revenue, right? So it sounds like analysts right now, or the stock market, is pricing Shopify for at least almost 9xing its sales, with price sales ratio of 8.7. It's quite higher than its peer. So yes, Shopify is down from its all-time high of 180 or 52-week high of 179 that we just looked at it. But with a price to earnings ratio of 8.7, this is certainly not a cheap stock, even at its current ratio. We obviously offer you the price to book value, but for a company that is growth stage as where Shopify is, this is probably not as relevant as we want for this analysis. So yes, the company is much more cheaper than where it was almost 12 months ago, but it is still not a cheap stock to purchase at this time, right? And I know, a lot of you guys will talk about whether this uh, cheapness or like the fair share price valuation, these are all mathematical, backward-looking calculations. It's one data point, but at least you want to know, had you had a chance to buy Shopify at a, let's say, 2 or 3x price to sales ratio, that would have been a very significant shopping opportunity or buying opportunity. We have 2 more to go in order to evaluate whether Shopify is the next 100 bagger of stock or not. The next one is all about leadership. Is there a skilled leadership with high skin in the game? So this one is a very easy one for me to answer because the company is known as one of the best founder-led companies with strongest skin in the game. So if you go to Shopify's basically investor website, and if you look at the company's governance, it will talk about its leadership team usually. And if you don't know where to find it, you'll see the company's leadership team who are in the company's status, who is in the company's board. And I actually see one of our friends here telling me that the screen is out of focus. So let me see if I can make it a little bit less zoomed in. So that could be the reason. On my screen, I see it is sort of focused. So let me know in the comments if the screen is focused or not properly, and I can just sort of adjust it. Another way to do it is probably do it this way. So let me know if it is not out of focus, and if you guys still see it or not. Happy to adjust it. Let's just make it a little bit bigger. So yeah, we were talking about the company's leadership team, and what the leadership is telling us, or what the company is saying is, Toby is the founder and chief executive officer, and that's what we really want to see. A lot of the 100-bagger companies have been founded and run by the original founders. And the reason behind that is that when you have the original founder of the company on as a leadership, they have the skin in the game. Their incentives are so aligned with the incentives of the stakeholders that you would be able to trust that leadership team to be able to grow that company to its ultimate success, and that is quite important. So I would say, from a leadership point of view, this company certainly has a strong leadership team, founding team with strong skin in the game. So this is a good yes. Solid team, solid leadership team, with original founders in place. We have one more analysis to do in order to evaluate whether Shopify is the next 100-bagger stock or not, and that's about whether the company has competitive advantage or moat. But before I get there, talking about leadership with high skin in the game, I want to tell you about our company and our recent fundraising on Republic. Just like Shopify, and let me bring this screen for you. Just like Shopify, StockCard has its original founder in place, Hoda Mehr, founder and CEO of StockCard, and we are here to shape the future of retail investing. And right now, to support our future, we're basically raising a crowdfunding round on Republic. It's republic.com /StockCard, and we really hope to have you guys with us. So if you are interested in learning about our future aspirations, what we're building, what we've achieved, and learn about my background as founder of the company, please head on republic.com /StockCard and learn about what we are building at StockCard, and hopefully join us as an investor. All right, going back to Shopify, we're down to the last aspect of evaluating the company's basically suitness or fitness to become the next 100-bagger. And that's about competitive advantage. So competitive advantage can be, you can define competitive advantage in many different ways, right? You could talk about the technology, the scale, the strength of its company's technology. There's things like network effect, things like the stickiness of the company's technology for its customer. There's a lot of things too. Brand could be another source of competitive advantage. What I really like about a Shopify that I wanted to show you, it's what basically they show on their quarterly, the latest quarterly earnings report. They presented, they did this presentation, and they were showing the retention and the revenue that they generate from their customers, cohort after cohort. And I really thought this really shows the power of the company's competitive advantage, that I thought it would be interesting to have a conversation about it. And this is it. This is the slide if you see it. Basically, what is showing that the longer the companies stay with the longer the users or the customers stay with Shopify, the more they generate revenue for the company. So, and the way they calculated is that they took the last 4 quarters of the company, the revenue that was generated from the users who joined back in 2015. So they took the revenue of last 4 quarters, and then they divided that by the revenue that came through the first 4 quarters of them joining in 2015. And they repeat that for customers who joined in 2017, customers who joined in 2019. And as you see, and they share these numbers, is that the longer the customers are staying with Shopify, the more revenue they're generating for the company. So those who joined in 2015, now they increase their revenue, their spend basically with Shopify by more than 3x. Those who joined in 2017 Q1, they increased their revenue by almost 2x. And those who joined in 2019 by 1.5x. And this, to me, is a solid indication of competitive advantage, meaning that when you join as a customer to Shopify, you not only you stay, but you increase your spending for the company. And that is because somehow the technology is sticky, and somehow as you stay with the company, you spend more and more with it, and you stay longer and you spend more of it. And to me, that's the strongest form of competitive advantage you could find for a company. So yeah, measuring mode or competitive advantage is a very difficult thing to do, but if a company gives you indications of retention, indications of a spend by its existing customer, and if it's as solid as Shopify, this is definitely a very good sign. So we say high competitive advantage, and there's all other evidences for it. They are introducing their mission, as they say in this earnings report. We were just looking at it together. Where was it? Here. They talk about becoming the retail operating system. And when you want to become a retail operating system, it means that you're offering this whole slew of products and services and offerings for the retailers. And that makes your platform sticky. With a mission like becoming the retail operating system, and with those figures we just looked at, this company certainly has a very high competitive advantage. So let's recap of Shopify. Is a company, whether it's a next 100-bagger or not, it has solid revenue growth with some blips in latest quarterlies, but not as concerning as you would think, because it's a short-term thing. It does generate free cash flow to reinvest, and it's been able to increase that free cash flow year after year. It does have very solid leadership team. Its original founder is still in place and has really a very strong, obviously, skin in the game to make the company successful. And we looked at evidences of competitive mode or stickiness, and that was also there. The areas of concern is that it's already a $40 billion company. So in order to for it to become a 100-bagger, there's a significant amount of growth needs to happen. This company needs to become a $1 trillion, much bigger than $1 trillion company to become the next 100-bagger from what it is today. And that's if it was a $4 billion company, that would be a no-brainer. And does it have a history of expanding its earning power? It's a very capex or capital expense heavy company, although it's a software provider. But think about their businesses, their funding business, their fulfillment center, which is basically competing with Amazon's fulfillment. Those are all very physical and capital extensive offering, and that makes it very difficult for the company to be able to generate enough earnings consistently over the years to be able to fund its growth. So if there is anything, and then the last concerning area is it's not as cheap. Although it is down 80% from its all-time high and its 52-week high, it's still not as cheap of a stock as one could hope. So one thing, if I was gonna decide on Shopify later on, whether it's a 100-bagger or not, I would watch for the company's ability to fund its future growth through its free cash flow and earnings. Truly, we would want to go back and just see that company has that ability. It doesn't need to keep raising capital from external sources in order to fund its growth. That is very close to a possible 100-bagger, maybe not quite a 100-bagger, but it's a very, very strong company. I wouldn't add it to my 100-bagger portfolio yet because of my concerns on earning power and its size. But full disclaimer, I own this company through owning ARK. So I own ARK, ARKK, so ARK's ARK Invest flagship ETF, and Shopify is one of the holdings in there, and I can actually just show it to you quickly. So if you look at the ETFs that are holding Shopify, you'll see the first one is basically, the first one is ARK F, right? ARK FinTech Innovation. And basically it's in a lot of the ARK's products, and I own ARKK, which is ARK's Innovation Fund, this flagship, and I own it through that. So wrap up, it's not going to find its way to my 100x portfolio due to size and earnings power questions. I would follow and monitor this company in the future, but I certainly think it's a very powerful company to own into your portfolio, even though it may not be the 100-bagger, the elusive 100-bagger that we're looking for. Thank you again for watching. If you watched live, thank you guys for giving the feedback that it was out of focus. Hopefully it got fixed. Thank you for watching live. And if you're watching at a later time, please leave a comment, and hopefully we see you in the next live stream, the stock research that is going to be on Monday at 2 p.m. in the afternoon Pacific time. Thank you. Have a great Friday. Have a good weekend. See you soon.